Hey guys, Stockaholics, I appreciate you guys for being with me today. It's been a long week, but it's over. Many of you guys may know that I am a teacher. The semester has ended, and thankfully, I have 3 weeks off. And because I have those 3 weeks off, I would like to go, part of my goal is to go deep into the lab and learn a lot about some finance related things. Some of those ideas that I've had lately that I want to get back into are the copper industry, and the rally we've seen in that, along with the oil industry, what we've seen in that price rally, all kinds of commodities, and my thoughts regarding that. And if you guys want to hear, I'm going to probably make a couple videos on those kinds of things. But if you guys would like to know anything else that might be in my sphere of ideas and influence, let me know in the comments below, and I may consider making a video on it. Yeah. Today I would like to talk about a concept known as TINA in the investment community, or there is no alternative. This is a phrase made famous by Margaret Thatcher, a former Prime Minister of the United Kingdom. And I wanted to kind of think about this in terms and some context in terms of the stock market mania that we have seen recently in the past few months. Now, recently we've seen kind of a mania in all kinds of asset classes. First of all, over here we have the S&P 500. It is up 16% year over year. The market cap is at an all-time high of roughly $31 trillion. In the last year, $5 trillion has been added to this index. Bitcoin reached a market cap of $350 billion, and $220 billion has been added to this asset's market cap in the last year alone. The Russell 2000, the small cap index, has reached a all-time high. It has been going absolutely parabolic in the past few weeks, and year over year, it is up $600 billion versus a year ago, or year over year has increased by 17%. And you know, if you think about the economic conditions that we've been seeing to lead to these kinds of things, it's absolutely insane. And I guess I wanted to try and explain that today, or at least make sense of it. As you know, I don't know if anybody can really explain it, but I wanted to try and understand it a little better. I also wanted to show you guys this briefly to kind of put things into perspective. I got this from a YouTuber named John Palomi. He's got some incredible ideas and content, and I would highly recommend you check him out. I watch a lot of his stuff. In any case, he got this from Bloomberg, and he called this slide the most overvalued market ever. Now, there's all kinds of ways that you can measure stocks. You might measure them in price to book, price to earnings. Maybe you could measure them in terms of the enterprise value. And you can see that over here there's different ways that we can measure prices for these kinds of assets. In this case, we're talking about the S&P 500. Now, what I find to be fascinating is this right here, the historical percentile. And it is displayed in this fantastically beautiful shade of alarming red, red-orange, we'll call it. And you can see that all of these ways that you would measure the S&P 500, and this is, I believe prior to Tesla being added to it, by the way, that we are in the most insane valuations, no matter how you slice the pie, no matter how you want to measure it, for the S&P. And this isn't true. This is not just true for the S&P 500. It's true for all kinds of asset classes. But what does that mean in terms of TINA? That's what I wanted to try and figure out. So one of the questions that comes to my mind is just, you know, where the heck is all of this money coming from? This is an article from Dion Rabouin from Axios. I won't read through the whole thing, but I would recommend you guys, if you want, pause, read through it. But I'll go over some of the big ideas here. And essentially for the third quarter, loan growth at U.S. banks has declined as banks have been tightening lending standards and demand from businesses has been falling. And this hasn't really changed since the end of the third quarter. And I'll show you guys some proof of that in a little bit. Now you might be thinking, well, who cares? What does that have to do with the stock market and how stocks are going straight up, right? Well, if you understand how the monetary system works, the way that money is supposed to be created in any case, obviously there's some debate on that in terms of shadow banking, but in any case, essentially the way money is created is when banks give loans. So the overall money supply should be increasing as banks are giving loans, right? But you can see that banks are requiring higher credit scores because essentially during a recession, more people are out of work, more people are out of a job. Businesses, they face more risk of becoming insolvent. And because of that, banks they're in it to make a profit too. They don't want to make loans if there is increased risk. So, and we're also seeing small businesses seeing higher requirements to get loans, right? There's just all kinds of constriction in the lending market. And what this tells me is that in reality, the total money supply, the amount of money that there is, should be decreasing. So this is another way to think about this. This is consumer loans from all commercial banks taken from the Fed. You can see prior to the cerveza sickness, we were in a nice expansionary phase in the economy. Banks and the total money supply was increasing because banks were giving out loans. The restrictions on loans were looser because there was less overall people that were credit risks. However, when we saw the cerveza sickness take root and we saw government shutdowns and government mandated destruction of small business, it also it decreased the amount of loans that we can see in the market. Banks are, like I mentioned before, they're in it to make a profit. If a small business or an individual is a credit risk or is likely to be operating in a business that is going to become insolvent, they're not excited to give a loan. And you can see in quarter two that it was quite low. However, the most recent quarter that has ended, you haven't seen any growth in loans. So what this should mean is that the money supply should at least have stayed the same. And inflation should not be able to explain why we have seen stock prices go straight up, and up. And there's another way to think about this too, is in terms of credit. People are spending less money in the overall economy. And if the overall economy is sluggish, this is another form of debt, which should be increasing the money supply if it is going up. But it is not, and it is in fact doing the opposite. And you can see that in fact in quarter three and to date, it is on a slight downtrend. Now, some of you guys might be saying, stockaholics, wake up. Obviously, it's stimulus, right? The Fed has printed $3 trillion from the last stimulus bill, and that has to go into all kinds of assets, right? And to some extent, I agree some of that money must have gone into assets. But if you think about the growth that we have seen in all kinds of assets, in the S&P 500 alone, this year, we have seen $5 trillion in growth. Did the Fed print $5 trillion? I don't think so. So something else is happening. And that doesn't include any of the other asset classes where we've seen just tremendous amounts of growth. All right, so personally, I don't believe that the Fed actually has the ability to print money. And I also believe that we are, if not in a lower inflation phase because of the poor state of the economy, if not outright deflation, that there has to be something else that is explaining this absolute mania that we're seeing in the stock market, right? Now, before I also mentioned this, I mentioned this idea, Tina, right? And there is no alternative. And I think this is important especially if we are considering the bond market. If you guys don't know, the bond market is massive. It is larger than the overall stock market index, right? The amount of bonds is roughly, I believe, $40 trillion, and the overall stock market, which a little bit higher, I don't know, about 30 trillion, but I believe that's a little bit higher than that now. Now, if we're thinking about bonds, and bonds are yielding historic lows, they're about 1% interest for, we can say as an average. And if you think that we are heading into an inflationary phase, which I believe most people do, now again, I mentioned I don't share that opinion, it makes bonds extremely unattractive, and it represents interest-free risk. If you believe there's going to be inflation, and you're losing value of your money over the length of the maturity of that bond, you're not going to want to buy a bond. You say if there's a 2% annual inflation, but you're getting 1% growth on your bond, by purchasing that bond, you're losing money over the maturity of that security, right? Now, in addition to that, the Fed has also signaled that they're not going to be increasing interest rates for a long while. I believe they're not going to be doing that until 2023 or 2024, at least 3 years from now, right? So if you're thinking about that and you're like, you think about how much money is in this bond market, with so much money, as those bonds get mature, the people who own those securities, are they going to want to buy new ones? Are they going to want to continue to buy? They're going to roll over that into another bond when that bond expires. Now, let's say that you are a pension fund manager. Let's say, for example, you're in charge of the California State Teachers Pension Fund, and that you need to find a way to create consistent yield in order to make those pension fund payments to all of those retirees. Now, previously, you might have been able to buy bonds when they were at, let's say, 8, 9, 7, 6, 5% interest rates to be able to make those payments on that pension, right? Or let's say, for example, that you are a hedge fund, maybe that you're even interested in bonds at once upon a time, or that you're just Joe Blow and you wanted to invest in bonds when they had a decent yield because it was a safe, secure way to get a payment or to earn money over time, right? You earned a yield on your money. What do you do when bonds are at 1% interest rate? If you're in charge of that pension, let's say, for example, you need a 7% average interest on the amount of money in that to be able to continue the fund to continue to pay those payments. Are you going to continue to invest in bonds? Probably not. Or if you're average Joe Blow and you notice that inflation is higher than the amount of interest that is being offered on a bond, are you going to buy a bond? Probably not. So what are you going to do? Well, there's no alternative. You're going to have to seek yield elsewhere. Now, there's some interesting similarities that I noticed about the mania today in relationship to the mania in the Netherlands in the 1600s, referred to commonly as the tulip mania. In the Netherlands, the price of tulips skyrocketed for a bunch of reasons. But one of the reasons that I've heard about recently, as I was reading some things, is that many historians attribute this bubble to something called the bubonic plague. Now, the plague had been ravaging a lot of Europe. A lot of people had died. And in terms of that context of that situation, it made risk-taking easier, I think. If you think that you're going to die or that you might die, you might be more willing to take risk. Now, let's think about what happened in 2020. We had something called the coronavirus. Now, I think for most people, the effects of the coronavirus pretty different than in terms of the bubonic plague. But I know that there's a significant percentage of the population that are genuinely afraid of the virus. And if you think that your days are numbered, perhaps you might be more willing to take risk in the stock market. Perhaps you would say, you know what, I'm going to get into it. What do I have to lose? And on top of that, we saw the dynamics where many people throughout the year have been locked down. Um, and you saw the rise of the Robin Hood trader, if you will. Although I don't think that the amount of dollars for these people, at least the retail investors, is enough to create these kinds of manias alone. It does ask the question: is there a relationship here? Now, I guess I'll close by saying, this isn't financial advice. But I guess I want to say that, history doesn't necessarily repeat, but it certainly rhymes. And being a value investor, or at least a contrarian investor, when I see so many people doing one thing, it makes me want to do the other. Now, recently, I won't say that I've sold everything, but recently I've sold significant portions of my stock portfolio. And maybe I'm wrong. Maybe the stocks go to infinity and beyond, and I'll have made a gigantic mistake. But to me, it doesn't make a lot of sense to buy something expensive just because it's going to get more expensive. I'm going to continue to seek out value wherever that may be. And a lot of the things I'm interested in are foreign markets. I'm interested in different parts of the world that are still considered cheap. Now, a lot of the stocks that I still own, I still do consider to be value investments.